Welcome to Chapter 12 in Intermediate Accounting. This is likely your first chapter in Intermediate Accounting 2, which means congratulations are in order because you finished Intermediate Accounting 1, so great job on that. Unfortunately, as we progress further and further in the book, which is what we're doing with Intermediate Accounting 2, the chapters do get harder. The content is going to be deeper, and in Intermediate 2, you're going to see many new things versus Intermediate 1, where you primarily just dug deeper in what you learned in financial accounting. But that's okay, because I'm going to be here to walk you through these. I'm going to walk you through each of the chapters in Intermediate Accounting, and what I like to do, since the chapters are so intense and long, instead of doing like a 2-hour video, I break it out into probably an average of 20-25 minutes per video. That way you can just get little sections of the chapter and try to digest that as you go along. So let's go ahead and jump into the investment chapter, which is chapter 12. So first, the two major categories of investments when it comes to a company would be equity, which is where the investor gets actual ownership in the company, which we typically see as common or preferred stock. The other major category is debt. This is where the investor is actually lending the company money. And we see that through notes payable, if it's a bank typically, or through bonds. And this is where individual investors can put their money into a company and then they're going to be owed back. So they are essentially the banker. So what is the objective of these instruments? So of course, as an investor, they want to earn a return on the investor's money. That is the whole purpose of us investing, is we want to make money off of our money. So let's look at how that is done with these debt securities. So when it comes to a bond, the face amount is paid to the investors at maturity. Now, the face amount is going to be told to you right away when you purchase the bond. Usually it is $1,000 per bond. So that $1,000, let's say, would be paid to you at the maturity date, which may be 5 years from now, it could be 10 years from now, it may be 3 months from now. Bonds are going to vary, but you'll see upfront when that's going to pay out. And in the meantime, there will also be interest paid between the time that you purchase the bond and that maturity date. And typically the interest is paid twice a year. We usually see it June 30th and December 31st. So if there's 10% interest, they're going to get 5% of the interest June 30th, 5% on December 31st. So let's start looking at what it looks like to purchase a bond, and then we're going to jump into some examples. So we have the stated interest rate. Anytime you see the stated rate, that is what the company is actually going to pay in interest in cash to the investors on those biannual payments. Then we have the market rate. The market rate is how much you could find if you were to invest in bonds in another company with a similar bond. So this is what you could get outside of the company that you're investing in. So, most companies are offering 12% and this company is offering 10%. So we are going to compare. If the company that is issuing the bond has a stated interest rate that is higher than the market rate, higher than what you could find with similar investments, then that bond will be sold at a premium. So if the face value is $1,000 per bond, this bond is going to be sold at more than $1,000 to the investors. They're like, hey, you're going to get 1% more in interest than you can find anywhere else. So it makes it worth it for you to pay extra to get this bond. So if it's a $1,000 bond, let's say they sold it for $1,100 just to make the math easy. So the premium was an extra $100. Now at maturity, this is super important. At maturity, the investor still only gets the face value. They still only get that $1,000. So they paid more upfront in order to earn more interest over the life of the bond. But at the end, they still only get the $1,000, even though they paid $1,100. What if the stated interest rate is lower than what you can find in the market? In this case, the only way an investor is going to want to buy a bond with a lower interest rate than they could find elsewhere is if it was offered at a discount. So maybe the face value is $1,000, but they're selling it for $900. So they say, hey, yeah, we're only offering 8% and you could get 9% somewhere else, but you only have to pay $900 for this bond. And you are still going to get the $1,000 face value at maturity. So that is the key here. At maturity, the face value will be paid out regardless of how much the bond was purchased for. Then there's also the situation that what if the stated rate is the same as the market rate, and in that case, it's just sold at par value, which means it's sold at the face value. Par value, face value, same thing. It's going to be sold at the same amount as it'll pay out at the end. So we have to take that into consideration. I just wish everybody would sell them all at par value and we wouldn't have to do all these extra calculations, because you're going to see the bond calculations are quite challenging. But it's okay because we're in it together. So for each of my chapters, I like to have a different company that we cover, and whenever we dig into those examples, we're using that company. So our company for chapter 12 is TechNova Robotics Corp. So they design warehouse automation robots. So that's the company we're going to see throughout chapter 12. All right, so let's jump right into an example. On July 1st, 2026, TechNova Robotics issued $900,000 of 10% bonds dated August 1st. So in other words, they probably issued 900 separate bonds, and it could go to 900 separate investors, or one company, which is what's going to happen here, could buy all of the bonds. Okay, so if you're somebody that likes to take notes, I've kind of put in bold here what I would put in my notes, because when we see word problems, sometimes it's like, oh my goodness, that is so much information. So for me, I like to pull these really important numbers and dates and put that separately so that I can keep track of what's really important in that word problem. So they've got this $900,000 worth of bonds. They are paying 10% interest. That is the stated interest rate. Interest of $45,000 is payable semi-annually on December 31st and June 30th. So they're going to pay the 10% throughout the year. So they'll get 5% December 31st, 5% June 30th, to make a total annual amount of 10%. The bond matures in 5 years. Okay, so if they're making 2 payments a year, there's going to be 10 total payments throughout the 5 years. That's really important to remember as well. VentureWorks purchased the entire bond issue on a date when the market interest rate for bonds of similar risk and maturity was 12%. So the market rate is 12%. TechNova is selling theirs for 10%. So they're saying, okay, well, we'll issue these bonds, but we can't offer 12% interest. So in other words, they're going to have to issue this at a discount. So you probably learned all of this in financial accounting, and maybe it's coming back to you. But what we're going to dive deeper into is how to actually calculate from this point how much the bond would be sold for. So that's where it starts to get trickier. And that's what intermediate accounting is about, is digging deeper into each of these concepts. Okay, so this is the way we calculate how much the bond would actually be sold for, due to the fact that it is sold for 2% less in interest for a 5-year bond. We're going to start with the interest. So the interest is $45,000 twice a year. We could have also calculated that ourselves, because we could have taken 900,000 times 10%. That would have given us 90,000 a year. And we divide that by 2, and it's 45,000 every 6 months, which is exactly what they're going to pay out in interest. So we have 45,000 every payment period, and they're making that payment 10 times, twice a year for 5 years. So we are going to multiply that times a present value factor. And here's how we're calculating that present value factor. So first of all, it is going to be present value of just an ordinary annuity. Remember, annuity is going to be a series of payments, and this is a series of payments. It's $45,000 time and time again for 5 years, twice a year, so it's 10 payments. So we want to find the present value of this series of payments. So we use the PVA table, present value of an annuity. Now, here's the numbers that we use in order to find that factor. We are going to use 10 periods because it's 10 payments over the 5 years. And here's the really tricky part. We are not using the 5% that they're actually paying out. What we are trying to do here is compare it to the market rate. That's how we're calculating the discount, is comparing it to that market rate of 12%. So we're actually going to use the 12% in this calculation. So we take the 12%, the market rate, divided by the 2 payment periods, which gives us 6%. So this can be really tricky to remember when you calculate these, but we are going to the present value of an annuity table because it's a series of payments and we're trying to find what the present value of these payments are. We're using 10 periods because they are getting 10 payments over the 5 years. We're using 6% because we are going to be making semi-annual payments, so twice a year, and we are basing it off of the 12% market rate because that's how we're going to calculate the discount. So we take the 12% divided by the 2 payments a year, that gives us 6%. So we go to the present value of an annuity table, 10 periods at 6%, and it gives us this factor 7.3601. That was a lot. See, we didn't dig into this in financial accounting. This is why it's intermediate. We're digging in even more and we're getting all the details. So our interest, the $45,000 twice a year, times this factor we just calculated, gives us a present value for all of those $45,000 payments of $331,205. Now, the interest total over 10 payments will be $450,000, right? $45,000 times 10 payments, so it'd be $450,000, but the present value of it is $331,000. We also need to find the present value of that payment at maturity, that face value. So the face value, the amount they're going to have to pay to VentureWorks that bought all of their bonds, is $900,000, regardless of what VentureWorks paid for this. TechNova is going to have to pay VentureWorks $900,000. So now let's find the present value of the $900,000. So what we do is we also go to the present value table, but this is not of an annuity because the $900,000 is only paid one time. So we go to the present value table. It's the present value of a payment one time. And we use the same criteria, the 10 periods and 6%, just like we used before, to get our factor. That tells us the present value of that $900,000 5 years from now is $502,000. So even though it's 5 years from now, we're still using 10 periods because there are 10 payment periods. When we add those two numbers together that we just calculated, it tells us that the present value of these bonds, taking the market rate in consideration, is $833,765. So that amount, the $833, is what VentureWorks will pay for TechNova's bonds. Is a lot. We're jumping right into this. That's the tough part about a semester that just continues on, is that it's not like we're starting from chapter 1. We're just going right in the middle of the book. All right. So now let's look at how the journal entry would look for this. So we know that VentureWorks paid $833,765 for the bonds that have a face value of $900,000. So we are doing the accounting for VentureWorks. So VentureWorks is making the investment. So since this is the investment side, we are going to show that VentureWorks now has an investment in bonds of $900,000. So that's how much they're going to get at the end of 5 years. But they only had to pay cash for the $833,765. So the difference between the two is a contra asset, which is going to be discount on bond investment. So we then record a credit to discount on bond investment, which we will have to amortize over these 10 payments. All right, so let's look at calculating the interest payments. Okay, so that was when they first bought the bond. Now they have to make their first interest payment. We know the interest is $45,000. They already told us that, but this is how it was calculated. $900,000, the face value, times the 10% divided by 2, because it's 10% for the whole year, but they only get half at each interest payment. So the actual cash interest paid out to VentureWorks is going to be based on the face value. But then we're going to show interest expense for, it would be interest expense for TechNova, but it's going to be interest revenue for VentureWorks. So VentureWorks is going to show interest revenue based on that market rate. So they're going to take the outstanding balance, which in the beginning is the $833,765, times the half of the market rate, since it's 2 payments a year, and their interest revenue is $50,026. The difference is the amortization on that discount on bond investment. So VentureWorks is actually getting $45,000 in cash from TechNova, but they're showing interest revenue based on that discounted amount. So the difference between the interest revenue we just calculated minus the $45,000 in cash, that $5,026, that is going to be decreasing. We're going to be debiting that credit account. So we're decreasing the discount on bond investment by $5,026. So this is what it looks like to amortize or get rid of the discount over these 10 payment periods. So you can do this in Excel. In fact, I calculated this in Excel in order to put it into this slide. So what you do is you start out with the amount that they actually paid, and then we take into consideration the cash payment, which stays the same every single payment period. The effective interest rate, though, is 6%. It's half of the market rate. Then we take the effective interest rate, the 6%, times the amortized cost, the amount, the outstanding balance, basically. That gives us the effective interest rate, the effective interest amount, which we just calculated on the last slide. 6% times 833,765 tells us the effective interest was $50,026. So the increase in the balance is the difference between the effective interest minus the $45,000. So it gives us $5,026. That's the debit to discount on investment. That's the same calculation we just did on the prior slide. So then we take the amortized cost that's sitting there on the balance sheet. We add the increase in the balance, and now the outstanding amount, or the carrying value of the bond, is $838,791. Then we do the same process, but now we're going to use that new balance. We take 6% times the $838,791, and that gives us effective interest for the second payment of $50,327. The difference between that $50,327 minus the cash that was paid is going to be amortization of the bond of $5,327. So we would be debiting cash for $45,000 as the investor, as VentureWorks. We are debiting the discount on bond investment to slowly get rid of it, to amortize it, of $5,327, and we are crediting interest revenue for the $50,327. So we do this for each and every payment. It's just each time it's based on the carrying value of the bond times the 6%. And then we take that amount minus the cash, and that increases the bond. So we do that all the way until it eventually gets back to the $900,000. And it does that conveniently on the day that the bond would be paid back to VentureWorks, to the bondholder. So we add it whenever it's a discount, and if we had a premium, we would do the exact same process, but we would subtract it, and we would be getting it back down to the face value. I feel like now is a good time to stop this first video because that was a lot of information. So I think it's a good time for us to take a little break. If you want to rewatch the video, you probably started out with double timing me and now you're like, wait a second, maybe I need to like slow motion because that was a lot of information. Or maybe it clicked instantly, which is awesome. Make sure you watch the next video because we're going to jump into a lot more when it comes to investments and securities.